Welcome to this explainer. Today we're cutting through the noise to look at the absolute core of the Vietnamese financial system. We're going to break down exactly why state-owned banks are the undeniable capital engine driving Vietnam's 2026 to 2030 economic surge. We'll be analyzing the true health, the massive catalysts, and the underlying risks of the Big Four, specifically Vietcombank, BIDV, Vietinbank, and Agribank.
Right off the bat, I want you to keep this single idea in mind. The important question is not how fast state-owned banks can grow, but which banks can lead Vietnam's capital flow in its new growth era. To truly grasp what's happening in this market, we've got to look way past short-term retail hype. We need a rigorous CFA-style mindset to pinpoint exactly which institutions dictate the systemic flow of capital.
Here's our roadmap for today. We'll cover the capital backbone, Big Four advantages, funding infrastructure and FDI, the FTSE and MSCI catalysts, key risks to monitor, and finally, a core investment strategy. Let's dive right into Section 1, the capital backbone.
The mechanics of Vietnam's growth absolutely do not happen by accident. It's basically a giant pipeline. The State Bank of Vietnam channels its monetary policy directly through these major state-owned banks. They act as the primary arteries of the entire economy. From there, these banks fund the mega projects and the massive businesses that pull in foreign direct investment. And ultimately, when that infrastructure is built and those earnings grow, it drives the broader equity market re-rating. If you want to know where the stock market is heading, you simply follow this exact flow of capital.
Moving to Section 2, Big Four advantages and their systematic health. According to data from Rong Viet Securities, each of these institutions has a highly specific, undeniable moat. Take Vietinbank, or CTG. They generated $1.27 billion in pre-tax profit in 2024 and capture a massive 11% share in corporate banking. They're the heavy lifters for industry and trade. Then you've got Agribank, sitting on over $80 billion in assets with an unparalleled rural network. You have BIDV pushing incredibly aggressive credit growth targets of 15 to 16%. And of course, Vietcombank standing tall as the overall system leader in asset quality. They aren't just competing with each other, they're essentially dividing and conquering the macroeconomic landscape. But look, you can't grow without fuel, right? Based on reports from The Investor, BIDV is executing a massive $391 million private share placement in the first quarter of 2026. Why? To secure the Tier 1 capital they need to safely hit that ambitious 15 to 16% credit growth target, all while keeping their non-performing loans strictly under 1.5%. This is exactly how major systemic banks gear up for a new era of growth. So as disciplined investors, we aren't just getting distracted by total assets or a flashy quarterly earnings beat. We monitor these specific metrics as our dashboard fuel gauges. CAR, or capital adequacy ratio, tells us exactly how much a bank can legally and safely expand. NIM, net interest margin, proves their actual profitability against rising funding costs. CASA is the absolute holy grail for securing low-cost funding. And finally, NPLs and provisioning reveal the absolute truth about their asset quality. If you aren't tracking these four metrics, you're just flying blind. Let's look at Section 3, Funding, Infrastructure, and FDI. Once these massive capital pools are secured, where's the money actually going? As highlighted by FinRatings, these state-owned banks are the irreplaceable financial backbone for critical national infrastructure. We're talking offshore wind farms, massive energy transitions, expressways, and sprawling industrial parks. These aren't just standard corporate loans. These are nation-building megaprojects that act as the prerequisite for attracting high-level foreign direct investment. And funding at this scale requires something private institutions simply cannot manufacture overnight: profound system trust. Thanks to their scale, their low-cost deposit base, and direct policy support from the government, the Big Four are uniquely positioned to absorb the massive risk required for Vietnam's rapid industrialization. They literally have the only balance sheets big enough to shoulder this entire era of growth. All right, Part 4, the FTSE and MSCI catalysts. Now zooming out to the macro picture, notice the precision of this timeline. Based on incredibly detailed data from the Lumen Vietnam Fund, Vietnam is executing a strict internal development roadmap. Right now, we're seeing aggressive legal reforms regarding foreign ownership and IFRS reporting. This is aimed squarely at locking in a confirmed FTSE emerging market upgrade by September 2026, with an ultimate goal of an MSCI upgrade by 2028. And remember, markets are forward-looking. The smart money is going to position itself well before that September 2026 effective date. The prize for hitting that timeline is staggering. Lumen estimates that this emerging market upgrade could surge daily market liquidity to an incredible $2 billion. That is a massive wall of passive, mandate-driven foreign capital that will be forced to buy into the Vietnamese market. And where does that ETF and index money go first? It flows directly into the highly liquid heavyweight VN30 stocks. It flows directly into the state-owned banks we're analyzing right now.
Section 5. Key risks to monitor.
Look, a sound strategy requires stripping away the FOMO, so we have to constantly weigh the scales here. On one side, we have historic catalysts, surging FDI, huge public investment, and those impending emerging market upgrades. But on the other side, we face very real roadblocks. NIM compression is a massive threat, as banks are forced to offer competitive loan rates while their own funding costs rise. We also have to track external pressures like Fed rates and US dollar strength. Plus, we must be incredibly mindful of Vietnam's high credit-to-GDP ratio, meaning the central bank has to tightly control overall credit growth limits.
You can see this tension perfectly illustrated in this data from Wrong Viet Securities regarding BIDV. On the surface, their total operating income and net profit are projected to grow beautifully through 2030. But if you look closer, the return on average equity has actually been trending downwards since 2023. Why is that? Because their net NPL formation, the creation of new bad debt, remains persistently high compared to peers like Vietcombank. They have to continuously build up capital buffers and provision for that bad debt, which dilutes shareholder returns even as raw profits look great on paper. This is exactly why you can't just buy a bank because it's big. You have to understand the true quality of its earnings.
Finally, Section 6, Core Investment Strategy.
Let's distill all of this into a clear, actionable framework. This is the Lean PT Ultimate Banking Checklist for the next few years. Base your thesis around these 5 keywords. Obsessively track bank health through these 5 indicators. Anticipate the 3 major catalysts and actively hedge against the 3 core risks. Keep this precise checklist handy to filter out the daily noise and focus purely on the fundamental signals. Let me leave you with this absolute core truth about the market's architecture. In Vietnam's new growth era, state-owned banks are not only defensive stocks, they are the capital backbone behind infrastructure, FDI, industrialization, and the re-rating of Vietnam's capital market. If you believe in the long-term industrialization of Vietnam, you inherently have to believe in the institutions financing it.
So, elevate your strategy. Don't just look at quarterly bank profits. Follow LIM to understand the story behind NIM, CAR, capital flows, and the strategic role of banks in Vietnam's new growth era. Mastering these mechanics is exactly what separates informed investors from retail speculators.
Which of these banking giants will you trust to anchor your portfolio as that $2 billion daily liquidity wave hits? Keep focusing on the fundamentals, and we'll see you next time as we continue to navigate the 2026 to 2030 cycle.